Today we're launching our July bi-monthly report, focusing on recent trends and transactions in all sectors of the Irish commercial property market at the mid-year point. In a nutshell, the first half of 2017 has been very, very busy, albeit a different kind of busy than the phenomenal performance of the market between 2014 and 2016. Despite continued uncertainty around Brexit, it is encouraging that activity has continued at pace in all sectors regardless. Although activity in the occupier markets is very strong, the volume of transactional activity in some sectors, such as hotels and investment, is down year on year due to the smaller lot sizes being offered for sale compared to the large assets and portfolios that would have traded in recent years. Despite somewhat of a slow start to the year, the first half of 2017 overall has been busy, and there's currently a large volume of deals underway in all sectors of the commercial property market, as well as several assets being prepared for sale. There's been a notable increase in interest in forward funding opportunities since the beginning of the year, and we're likely to see more new forward funding transactions announced over the course of the coming months. This bodes well for an even better second half performance, although year-end totals will invariably depend on which transactions sign by year-end. Looking at the office sector, a robust 50,000 square metres of office leasing transactions were signed in the first quarter in 40 individual transactions. We don't yet have numbers for Q2, but it is likely that the second quarter will be considerably higher than Q1, resulting in a very healthy first half performance of office take-up in the capital. There has been a number of significant pre-lettings or lettings in buildings that are still under construction over recent months, which demonstrates that occupiers are much more comfortable committing to schemes when there's clear visibility on delivery. There has been some softening in demand from new entrants in the first half of 2017, with the majority of the larger office leasing transactions that have signed in Dublin in the first half of the year comprising expansions and relocations of existing occupiers as opposed to new entrants. Financial services firms, business services and technology firms have been particularly active. In addition to regular take-up activity, which is strong, UK companies looking for a Dublin presence as a result of Brexit has created an additional layer of demand in the first half of this year. There are currently 31 office schemes under construction in Dublin, extending to more than 380,000 square metres between them, with more than 30% of this stock already pre-let. Meanwhile, another 44% of the office stock due for completion during 2017 specifically has already been pre-let, a proportion that is only going to increase further as other lettings sign and complete over the next couple of months. Meanwhile, in Cork, CBRE research shows that although there are 20 office schemes at various stages of the planning process at present, there are only 3 office schemes physically under construction in the city, of which the only speculative scheme is Block A, Navigation Square, which is due for completion in 2019. Prime office rents in Dublin remain stable at the mid-year point at €673 per square metre or €62.50 per square foot. Meanwhile, in Cork, prime office rents are in the order of €312 per square metre or €29 per square foot. In the industrial and logistics sector, demand for industrial accommodation is still very strong. However, occupiers in this sector continue to be frustrated by a scarcity of modern facilities along major road networks in the Dublin region, with take-up remaining constrained as a direct result of that scarcity of stock. Prime rents in the industrial sector have risen 6% in the first half of 2017 and are now in the order of €99.50 per square metre or €9.25 per square foot. Now that rents are close to a point where new development is feasible or viable, we expect to see new schemes that have a grant of planning permission commencing construction on a speculative basis in due course. Some of the demand for accommodation in the industrial and logistics sector is led by increased demand for last mile delivery as online sales continue to increase in the Irish market and as some companies amend their location strategies as part of their Brexit planning. In the retail sector, in addition to the length of time it is taking to get transactions across the line at present, the biggest challenge continues to be a scarcity of stores to match the sheer volumes of occupier demand for stores in established schemes and prime high street locations. Increased house building of late as well as strong employment generation, has seen the demand for bulky goods such as furniture and lighting and electrical goods increase significantly, which in turn has proved positive for retail parks around the country. Prime Zone A rents on Grafton Street remain stable again at the mid-year point at approximately 6,300 per square metre. In the investment sector, in addition to the 492 million of investment sales completed in the first quarter of 2017, we estimate that there's up to 1 billion of investment transactions currently in play, and indeed several assets being prepared for sale at the moment, which suggests a relatively healthy volume of transactional activity will be recorded in 2017, albeit down on the phenomenal volumes of investment activity achieved during 2015 and 16 when deleveraging was in force and some sizable portfolios and large shopping centres changed hands. Although yield compression has run its course in many markets across Europe, there is still potential for yields in the Irish market to compress a little further. Investors remain encouraged by Ireland's economic backdrop, its rental growth potential, and the underlying strength of occupier markets. Yields from multifamily residential or build to rent and student accommodation have already started to harden, in line with increased appetite for alternative investments. In the development sector, the scarcity of sites being offered for sale is frustrating, considering the number of investors that are looking to deploy capital in the Irish market at the moment. It is encouraging to see an increase in both planning applications and indeed new home completions in the first half of the year, but it's coming off a very low base. And if we are to achieve a meaningful improvement in housing delivery and attempt to match underlying volumes of demand for housing, drastic action is now needed. It remains to be seen what will transpire in the budget, but we do urge the new Minister for Housing to focus on supply-side initiatives, such as a temporary reduction in VAT on new home construction, that will help improve viability and in turn speed up the delivery of much-needed housing in the shortest possible timeframe. In addition to government's focus on facilitating supply, the central bank now need to review whether buyers who aspire to home ownership are in a position to do so on the basis of existing income multiples, and whether these also need to be reviewed at this juncture. We expect to see greater focus on the release of larger sites or indeed portfolios to the market during the second half of the year. We also expect to see an increase in the number of licence deals, joint ventures and forward funding transactions in the development land sector over the course of the coming months. Transactional activity in the hotel sector in the first half of 2017 is down year on year at approximately €75 million, although momentum is now building after what was a slow start to the year. The relatively low volume of transactions signed in the first half is largely attributable to the aforementioned slow start and the scarcity of large-scale assets being released for sale compared to last year. Demand for prime hotel assets remains strong, fuelled by strong performance indicators, particularly in Dublin, where hotel availability remains seriously compromised. However, with considerable hotel development activity now underway in the capital, this situation will ultimately improve. According to our research, there are 14 hotel projects under construction in Dublin at the mid-year point, which between them will add more than 1,700 new hotel rooms in due course. 10 of the 14 projects are new hotels, 4 are extensions. A number of assets that were offered for sale over recent months, including Connemara Coast in Galway, the Knightsbrook Hotel in Trim in County Meath, and the Athlone Springs Hotel in Athlone, County Westmeath, are now at advanced stage of negotiation and should conclude imminently, and that will provide a welcome boost to transactional activity in the second half of the year. Only 4 Dublin pubs have sold in the first 6 months of the year, totalling just under 5 million between them. However, there are a further 14 pubs at contract signed or sale agreed stage with a combined value of more than 18.5 million, which will boost activity in the second half. Transactions agreed recently include the sale of Boland's in Stillorgan in County Dublin, the nearby Sandyford House and J.J. Smith's on Ainger Street in Dublin city centre. Meanwhile, an agreement to lease the Vineyard premises in Blanchardstown in Dublin 15 was recently agreed. So all in all, it's been a very busy first half to the year, but as we said at the beginning of 2017, transactional activity is likely to be heavily weighted towards the second half of the year in 2017, so a busy second half is now in prospect. To download our full bi-monthly report, please visit the newsroom of our CBRE Ireland website at news.cbre.ie.